Singapore is one of the best places in the world for dividend investors. Here, we have a mature market filled with stable, cash-generating companies, supported by strong corporate governance and steady economic growth. And best of all, there's no tax on dividends, which means whatever you earn is entirely yours to keep. But not all dividend stocks are created equal. Some companies may look very attractive with their CB high dividend yields, but after you bought it, they'll be like, you activated my trap card, and their share price drops 50%, while others may quietly grow their profits year after year, rewarding shareholders with sustainable rising dividends. In this video, I'll give you a step-by-step guide on how to pick and evaluate dividend stocks in Singapore, so that by the end of the video, you will know how to tell the difference between a true dividend gem and a dividend trap. Alright, let's jump right in. So the first thing I look for in a dividend stock, or any other stock for that matter, is consistent growth. Dividends should always come from profits. So if the company can't grow its earnings, then it's only a matter of time before they start cutting dividends. Ideally, you want to see a 5 to 10 year track record of steady increasing revenue growth. It doesn't have to grow every single year, because sometimes even strong companies can also face temporary slowdowns. But the long-term trend should be clearly pointing upwards. Take for example, on the left, we have Mapletree Industrial Trust. You can see that its revenue has been rising steadily over the years, thanks to new property acquisitions and higher rental income. That's what consistent growth looks like. And on the right, we have Singpost. Its revenue has stagnated and even declined in recent years, largely due to falling mail volumes, rising costs, and stiff competition in the logistics space. That's the kind of trend you would want to avoid if you are looking for reliable dividend growth. Though, of course, that's not to say that Singpost is a write-off. That's because even companies that face declining earnings over a long period have managed to turn their business around before. One good example of that is Singtel, which struggled for years with falling profits and heavy competition in its core mobile business. But over time, it started restructuring, cutting costs, divesting non-core assets, and expanding into digital services and data centers. And now, its earnings outlook looks much healthier than before. So yes, a turnaround is profitable, but it takes time, good management, and a clear plan. Until Singpost shows the same kind of consistent recovery in both profits and dividends, I would rather focus on companies that already have a proven track record of steady growth. Next, besides revenue, another key metric is net profit growth. Though this mostly applies to non-REITs, because for normal companies, profit growth reflects how efficiently the business is expanding and whether the management can turn sales into actual earnings. One very good example of that is of course DBS. Its net profit has been climbing steadily over the past decade. Compare that to a company like StarHub, where their net profit has been shrinking for years due to intense competition and margin pressure, and naturally, they are also forced to cut the dividends over time. As for REITs though, net profit can be quite misleading. That's because their earnings can often swing wildly due to property revaluations, one-off sales, or accounting adjustments. Instead, it's better to use their net property income, as it will reflect the REIT's true cash generating power. So if you compare, say, Mapletree Industrial Trust with Lippo Malls, you can see the difference quite clearly. Mapletree Industrial Trust net property income has trended upward over the past 5 years, supported by resilient demand and prudent management, even during the high interest rate environment. Lippo Malls, on the other hand, has seen its net property income decline due to weak tenant demand, currency depreciation, and asset devaluations. Quick pause. If you are looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry, at just 35 cents per trade on the US stock market. It also offers Ireland domicile ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. Okay, besides revenue and income growth, the next thing I want to look for is also dividend growth. So much like your salary, the dividends also have to grow over time. Why? Because if your dividends stay the same while everything else like food, transport, and coffee gets more expensive, then your real income is actually shrinking ma. A company that can consistently increase its dividends year after year will show that its business is strong, its profits are stable, and the management is actually confident about the future. It's basically saying we are not just surviving, we are thriving, and we can afford to share more of our profits with our shareholders. On the left, you can see DBS. Its dividends per share has been rising steadily over the years, supported by higher earnings and a disciplined payout policy. And on the right, we have Singapore Airlines. Its dividends have no clear trend. Some years are good, some years are bad, and during tough times like COVID, dividends were completely suspended. That inconsistency tells you that the business is cyclical and unpredictable, which makes it a poor choice if you are aiming for a stable and recurring income. Here's another example. On the left, we have Sheng Siong. Sheng Siong is a classic case of a stable defensive business. It does well in good times and bad because no matter what happens, people still need to buy groceries to eat and toilet paper to bangsai. Its dividend per share has been gradually increasing over the years, reflecting its steady profit growth and strong cash flow. On the right, we have Netlink and BN Trust. While its distribution per unit hasn't really decreased, it also hasn't grown much either. Yes, while it is stable, which is fine if you value predictability, but it doesn't give you that inflation-beating growth that you ideally want from a long-term dividend stock. Moving on, the next thing I look at is the dividend yield. Dividend yield is basically how much dividend you are getting in relation to the stock price. And it is often one of the first numbers that catches most people's attention because let's be real, who doesn't like the idea of a stock that pays 8%, 9% or even 15% a year? Sounds super short, right? But here's the problem. If the yield looks too good to be true, it usually is. Because if we go back to the dividend yield formula, yield equals to dividend divided by price. So when the yield looks super high, it's usually because the share price has fallen. And that often happens for a reason. Maybe profits are falling, maybe the company has too much debt, or maybe the dividend is simply not sustainable. That's why I prefer dividend yields to be in the more reasonable range. In today's environment, where fixed deposits and T-bills are giving around 2 to 3%, a dividend yield of about 2% to 7% from a solid company is already quite decent. But then you might ask, why even consider something as low as 2%? Because as Uncle Ben says, with lower yield comes great growth potential. Okay, Uncle Ben didn't actually say that, but the point is, sometimes companies with lower dividend yields are reinvesting profits to grow, which means both their dividends and share price could increase faster in the long term. So don't immediately write off a dividend stock just because its yield looks low. One good example of this is Singapore Exchange. At around 2.4% yield, it's not exactly exciting, but SGX has a strong moat, stable profits, and it's been steadily increasing its dividends over time. Slow and steady wins the race. Another example is ST Engineering with a forward yield of about 1.8%. Again, not huge, but it is backed by recurring defense contracts and steady earnings growth. These are the kind of businesses that can afford to raise their dividends steadily. On the other hand, if you look at something like Asian Pay TV Trust with a whopping 10% dividend yield, that's where you should be like, brother, On paper, it looks amazing, but once you dig deeper, you see profits have been falling and debt levels are high, which makes that 10% yield unsustainable. This is what we call a dividend trap. Okay, here's a tip. One fast way to check whether a dividend yield is sustainable or not is by comparing a company's earnings per share with its dividend per share. If the earnings are higher than the dividends, that's a good sign. It means that the company is generating enough profit to comfortably cover its payouts. The dividends are coming from real earnings, not from borrowing or dipping into cash reserves. But if the dividend per share starts to exceed the earnings per share, that's a huge red flag. It means the company is paying out more than it actually earns. Sure, it may look generous in the short term, but if it is not sustainable, eventually the dividend has to drop. Last but not least, the debts to assets ratio must not be too high, or you risk investing in the next high flux, which got bankrupted because its debt went to the moon. This ratio tells you how much of a company's assets are funded by debt. In other words, how leveraged the business is. The higher the ratio, the more the company owes relative to what it owns. The ideal level will vary from industry to industry. But to give you a rough guide, REITs should ideally have a debt to assets ratio or gearing ratio below 40% or at most 42% to be safe. Anything beyond that starts to get risky because higher interest rates can quickly eat into profits and force the REITs to cut dividends. Meanwhile, banks like DBS, UOB and OCBC typically show very high debts to asset ratios, often around 90% or more. That might sound scary, but it's actually very normal for banks because deposits are counted as liabilities. In this case, debts is actually the money customers place with the bank, which it then uses to lend out and earn interest. For other industries, a healthy range is usually anywhere from 0% to under 90%, depending on the nature of the business. For example, Hopper has virtually no debt, which means it's sitting on a fortress balance sheet and can easily maintain dividends even during downturns. On the other hand, ST Engineering has a higher debt to assets ratio because it takes on long-term borrowings to fund large defense and infrastructure costs. But as long as the cash flow from those contracts are stable, that level of debt is still manageable. So those were the 4 main criteria that I look at when picking dividend stocks: consistent revenue and profit growth, dividend growth, reasonable dividend yield, and manageable debt levels. Of course, those are just the basics. There are still a few other criteria that you can look at. For starters, you want the company to have a sustainable dividend payout ratio. Basically, how much of its profits are being paid out as dividends. For most companies, a healthy range is usually between 20 to 60%. That range shows that the company is rewarding shareholders while still keeping enough profits to reinvest and grow the business. This rule, however, doesn't apply to REITs, since they are legally required to distribute at least 90% of their taxable income to qualify for tax exemptions. For REITs, a better indicator to look at is the net asset value per unit. Ideally, you want to see the NAV per unit rising over time, because that means that the REIT's properties are appreciating in value and its acquisitions are value accretive. But if the NAV per unit keeps declining, that's a red flag. It might mean that the manager is overpaying for properties, issuing new shares too cheaply, or making poor acquisitions that could dilute existing shareholders, basically destroying value instead of creating it. A really useful site for checking this is REIToracle.com. It shows you the historical NAV per units for the listed REITs in Singapore. For example, CapitaLand Integrated Commercial Trust NAV per unit has been trending up nicely over the years, while Sabana REITs has been gradually declining. Besides that, you also want to make sure you are not overpaying for a stock, no matter how good the business is. Even great companies can be bad investments if you buy them at the wrong price. For instance, if you look at the price-to-book ratios of the local banks, they are currently quite elevated, which means the risk to reward might not be that attractive right now. Meanwhile, Parkway Life REIT trades at around 1.7 times book value, which is close to its historical average, suggesting that it is fairly valued. On the other hand, ST Engineering looks expensive, whether you measure it by price to earnings or by discounted cash flow. So yes, fundamentals are key, but valuation still matters. Even the best dividend stock can turn into a bad investment if you buy it at the wrong price. Now, let's put everything that we have talked about into practice and actually use it to find some potential dividend stocks. For this, I'll be using Mumu's Stock Screener tool. Not sponsored, I just find it super convenient and easy to use. To access it, head over to Discover, then tap on Screener. From here, we'll select the Singapore market, which gives us around 650 listed stocks to start with. Let's begin by adding our filters based on the criteria that we have discussed so far. First, we'll add the revenue growth filter. Let's set it to an annual average growth of at least 0.1% over the past 10 years. Meaning the company must show at least some growth in revenue over time lah. Next, we will add the net income growth filter. Same thing, at least 0.1% CAGR over the last 10 years. This ensures that we are only looking at companies that have grown their profits, not just their revenue. Then, we will include the dividend CAGR filter. Again, let's set a minimum of 0.1% over the past 10 years. So, we only keep companies that have a consistent track record of growing their dividends. After that, let's add the debt to assets ratio filter. We will set it to less than 100% over the past 10 years, just to make sure we filter out companies that are too heavily leveraged. Finally, you will add the dividend yield filter. Let's set it to between 2% to 7%. Not too low that is too insignificant, and not too high that it looks too suspicious. And tada! With just a few filters, we have narrowed down our list from over 650 stocks to around 60 stocks. If we sort by market cap, you will notice a lot of familiar names here. The three banks, DBS, UOB and OCBC, as well as SGX, CapitaLand Integrated Commercial Trust, and some other solid blue chip names. But of course, the screening process doesn't end here. This is just a starting point. From here, you still need to do your own fundamental research to find out whether these companies are truly strong and sustainable. You can then use tools like IBKR's Fundamentals tab to dive deeper into each company, look at their financial statements, key ratios, and even check analyst reports to see how the market views them, study their business model, their future growth plans, and whether they have a strong competitive moat that can help them sustain profits and dividends over time. Because at the end of the day, picking dividend stocks isn't just about chasing the highest yield or timing the market perfectly. It's about finding solid, well-managed companies that can consistently generate profits and reward shareholders year after year. So take your time, do your homework, and focus on quality and consistency over hype and quick returns. Anyway, that's all for this video. Hope you found this useful. Like, share, and subscribe as I'll be posting new videos every week.